Backend team, please play ICI motto.
येष सुप्तेषु जागृति येष सुप्तेषु जागृति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तदेव शुक्रब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चनात्यपि कश्चन एतद्वैता 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 एतद्वैता.
We welcome you all, and I request our visionary chairman, CA Ketan Sayya sir, to please address the participants.
Thank you,
Yes,
Bishan Bhai. Thank you so much. First of all, let me congratulate Bishan Bhai, the Indirect Tax Committee Chairman, for curating the entire industry-specific program. He is one such guy who is, very, very dedicated to the entire committee of GST, and I've been seeing him as one-man army. Whether it is help desk, whether it is GST virtual program, whether there is an RRC in Goa, I think the committee is buzzing because of his action and dedication. So thank you so much, Bishan Bhai, for keeping this important committee, which is very, very important for each member in practice. Be him, be in the audit or the tax domain. I think the implications of GST needs to be understood by everybody. Today is very, very important session on banking insurance. I think again banking is such one industry which impacts each and every business, and we must know as auditor of bank, even in most of us do bank branch audit. So what are the GST implications, whether it is happening at branch level, whether it is happening at regional level or zonal level? We must have a knowledge, working knowledge of implications of GST, how much is allowable, where it is allowable, where input to be taken, what is the percentage. And I think we have fantastic faculty in the form of Rushil, who's got a great working knowledge of these domain. So Rushil bhai, thank you so much for your valuable time. The request to the all member to go to the website of WRC, see various programs and enroll for them. First unique thing, first time ever in the WRC we have done is the annual membership concept we have started. For senior member and women member, 9,000 rupees. For all other member, 10,000 rupees from 1st July to 31st March. A program worth almost 30 to 40,000 are being offered at just 20%, including all online program. Like today, if you enroll for ASM, annual membership scheme, even GST virtual programs are free for you. All programs which are happening in ICI campus at ICI Bhavan are free to you. The program which are happening outside a program outside the BKC, there is a 10% discount given. A unique initiative this year started by WIRC. So requesting all of you to enroll in this annual membership and take advantage of that. I'll request Indirect Tax Committee Chairman Bishan Bhai to talk about GST RRC, which is happening, and today is the last date for enrollment as early bird. Thank you so much. Over to you, Bishan Bhai.
Thank you so much, Chairman sir, for your kind words, and you are very humble, and I can say simple that you give us all credit. But actually, what we can say in Sanskrita is that Akashat Paditam Toyam Yatha Gachati Sagaram Sarvadeva Namaskara Keshavam Prati Gachati. So you are the only one who always try to keep all of us to be included in all the initiative of the WRC. And I must appreciate this initiative of WRC, where annual membership has been given to the members for single payment. So when we are talking about hassle-free programs, hassle-free, I can say one nation, one tax in the GST. So it's a kind of initiative that only one payment you need to make, and you are getting access to each and every program. Today is the Guru Purnima, and yes, we have our Guru today, CA Rushil Bhai, here with all of us. Yes, sorry, I was just disconnected. So we have our Guru today, CA Rushil Bhai, and Guru Brahma, Guru Vishnu, Guru Dev Maheshwara, Guru Shakshat Parabrahma, Tasmai Sri Guruve Namah. So Rushil Bhai, thank you so much on this auspicious day. You are here to make all of us learn in Swarupa of a Guru. So again, it's our pleasure that we are doing something of knowledge dissemination, and it's nothing but a Guru Puja for all of us. As Ketan Bhai has said about GST RRC, we are having GST RRC on 25th, 26th, and 27th of this month, and today is the last date for early bird. So I request all the members joining here to try to join this RRC also. It's one of its kind, where senior advocate Raghuramanji will be there, advocate Raghavan Rambandran is going to address, advocate Vaithishwaranji is here, again advocate and chartered accountant JK Mittal is going to come there and present their lectures. For the technology, we have Lapsiwalaji, who is there in Bombay as a partner of, I can say, E&Y. So try to take maximum benefit of the members, and all across the India, people are coming there. So it's a great opportunity to network each other. I request all to please register today itself, because we have only limited seats. Coming to the today's specific topic of GST, so far as the banking, financial and insurance sector are concerned. So Rushil Bhai will take us on the tour. What are the difficulties? What are the technical issues in these sectors, and how we can resolve this? So Rushil Bhai, again, thank you very much for taking your time, and you are here for deliberating, and I'm sure that you will cover all those issues, burning issues, which are focusing to this industry. Because what happens, like if banking, we are taking any foreign banks help, then department is saying that it's an import of service. So far as the taxpayer is concerned, whether are we covered or not. So far as the insurance is concerned, when there is an insurance claim, what one should do, or a taxpayer should reverse the credit, or what about the salvages and everything. I guess we are going to get inputs from you. Even in the mutual fund also, there are certain nuances and which we want you to address. If you think that there is any questions which has been raised by the participants and relevant to give answer at that time, then I request to give answer to at that time. Otherwise, post your deliberation, we can take those questions as well. And now I request, yes, as per the schedule, it was a transport and logistic, but due to some issues with Rushil Bhai, we have taken today banking and financial sector. So kindly accommodate us with this change. This transport and logistic will be on the next week, on 17th. It will be taken by the other faculty. So with these words, I again welcome all the participants, and thank you very much, Chairman Sir and Rushil Bhai. I now request CA Keval Trivedi to kindly introduce our learned faculty. Yes, Keval Bhai, you are mute. Yes, please.
Yes, sir. Yes. So thank you, Ketan Sayya sir, Chairman of the WRC, and CA Bishan sir, Indirect Tax Committee Chairman sir, for giving me this opportunity to introduce the today's speaker. Talking about the today's speaker, Rushil Shah is a qualified chartered accountant and a lawyer. He is the principal associate in taxing at Economics Laws and Practice, which is among the top ranked law firms and recognized as a tier 1 law firm for the tax in India. Rushil advises several domestic and international clients in structuring transaction from tax efficiency perspective, provides the legal opinion on international interpretational issues, reviews the contracts and undertakes tax optimization and due diligence exercises. He also assists the clients in with the strategic inputs and end-to-end supporting during the audit and investigations proceedings. Rushil also advises the client on the matter pertaining to the customs laws, foreign trade policies, special economic zone, and international financial services center. On the litigation front, the Rushil represent the client before the High Court and various judicial form as well as in the assessment proceedings. He is also involved in the various advocacy and policy related initiative before the various government ministries and other government authorities. Rushil advises and represents the client across the various sectors, which inter area includes the banking and insurance, which is today's topic, fashions and retails, media enterprise, shipping and post services, EV manufacturers, logistics, e-commerce, and etc. Prior to joining the ELP, Rushil has worked with the TLC Legal and KPMG. On the academic front, Rushil is a visiting professor for the tax at SP Jain Institute of the Management and Research, as also author various articles on GST, which are published across the various publications. Thank you so much, sir, and welcome you to the session.
Thank you. Thank you so much. It is my pleasure to be here. So, good evening, everyone. Before we start at the outset, I would like to thank WRC for inviting me as a speaker on this series of industry-specific issues under GST. While I have regularly attended sessions conducted by WRC, this is my first time as a speaker. And having attended those sessions, I know the benchmark and expectations set are really high. And I'm just hoping I'm able to do justice to that. Now, on that note, let us turn our focus to our topic for discussion today, which is the banking and insurance sector. Banking and insurance sector is not just the backbone of Indian economy, but it is also among one of the most complex industry sectors. Now, this added complication or complexities arise because both these industries are governed by their own set of laws, right? There are various regulations and laws that govern these two particular sectors. And now when we deal with certain aspects from a GST perspective, the regulations by which they are governed with add an added layer of complexity for these sectors. Apart from being highly regulated, these sectors also have a large volume of transactions and have operations across the country. That again adds on to the complexity of dealing with such transactions. Now, in today's session, we'll deal with the GST nuances for both these sectors. While we are aware about, we'll not get into each and every provision of GST law, but we'll deal with the provisions which specifically deal with these sectors and issues arising therein, right? So on that note, I think we'll start with today's session. I'll just share my screen. I hope the screen is visible now.
Yes, sir.
Right. So starting first with the banking sector, let us broadly understand as to what are the businesses or the kind of business that banks are largely involved in. While today we have seen that these big corporations and banks, they are operating in a very dynamic environment, but largely the functions or the business that a bank carries on is kind of summarized in this slide. So at the forefront of the functions carried on by these banks is the business of accepting deposits, that is operating those savings accounts and the fixed deposits that we have with bank. The most important function being lending of money, which is providing various loans and financing to certain industries and helping people in need of money. Another function is buying and selling of foreign exchange. Nowadays, we have seen that banks have also been assisting their customers in wealth management and undertaking certain investment activities on behalf of their customers. Then there is the traditional function of providing lockers and locker services for certain charge to the customers. Banks nowadays also offer various credit card services, and now we have seen that because of the number of digital transactions and everything increasing, there's a lot of focus is there on digital banking services. And to facilitate the customer, there are certain electronic clearance services that the bank offers to their customers. That is typically to deals with your utility bills and taking standing instructions for clearing those utility bills on your behalf. Right. So this broadly summarizes what business a bank carries on in the Indian scenario. Now, while under GST, the broad framework, there are some specific provisions for banking, and these are the large provisions which you normally refer to at the time of examining the taxability for a particular transaction and in respect of claiming credits. So first thing that we see is time of supply. Now, banks, as we know, they're all into the business of providing services. So the time of supply provision that applies to banks is Section 13 of the CGST Act, which deals with time of supply for services. However, there may be certain instances where banks also, sell goods, basically say certain old furniture or certain goods lying with them, which they sell it out. So in that context, limited to only those particular transactions, Section 12 of CGST Act will apply to determine the time of supply. Now, when we come to valuation, largely in a non-related party transaction, the banks adopt the transaction value, which is as per Section 15. Then there are certain inclusions that are required to be made as per Section 15(2). However, for their forex business, where they buy and sell forex, there is a special set of rules to determine the value in such transactions, and that is given in Rule 32 of the CGST rules. Broadly, when we talk about foreign exchange business, that is a transaction as such in money because currencies are being exchanged. However, the service element over there is this facilitation charges of exchanging the currency on your behalf. While at times there might not be a specific charge that they mention very specifically, the income of the bank over here is the margin that they earn on the buying and selling rate of the RBI reference rate. So the valuation rule also says that the value of, in such cases, should be the difference between your buying and selling rate as per the RBI reference rate multiplied by the total currency of unit. So typically, the margin that the bank earns in exchanging foreign currency, that is the value that is to be adopted in case of exchange of foreign exchange. However, there is also an option given to either I can go with this option of offering my margin to GST, or there is another slab-based valuation mechanism available where they say that up to rupees 1 lakh, you charge 1% of the amount subject to a minimum of rupees 250. Between 1 and 10 lakhs, you charge 1,000 rupees plus 0.5% of the amount. That 1,000 rupees is nothing but on the first 1 lakh, the 1% that I'm liable to pay. And if it is about 10 lakhs, then it is 5,500 plus 0.1% of the amount exchanged, subject to a maximum limit of rupees 60,000. So if the banks are dealing at higher volumes, they might prefer to go for the slab-based valuation. However, this option, if the bank, it is not a transaction-based option, but if this option is adopted by the bank, then that option has to be carried on for the entire financial year, and it cannot be changed in mid-year. So therefore, you have to be very careful when you adopt the option, because that option is going to continue for the entire year. Then another relevant provision in a GST supply scenario is your invoicing requirements. Now, in general cases, the time limit for issuing invoice is 30 days for non-bank or non-insurance taxpayers. But for banks and insurance, they've given a specific concession. They've given an enhanced time limit of issuing invoice of 45 days. That is as per Section 31, read with the Rule 47. However, another concession given is that if you're dealing with distinct person, like various branches within the country, if there is any transaction between them, then there is an option to either issue the invoice when the entry is recorded in books of account or at the end of the quarter in which such supply was made. Apart from this, the banks have been given an option to issue a consolidated invoice. So because what might happen, the banking business or the requirements when I approach the bank, that is a day-to-day activity which happens. So to further facilitate that, they have said that you don't need to issue an invoice for each and every dealings with your customer. You can issue a consolidated invoice at the end of the month. And another concession that is given is that because these invoices, the consolidated invoice and everything, it contains details of various transactions. They have said that this invoice might not be serially numbered and they may not even contain the address of recipient, which is a requirement in issuing invoice as per the for other non-bank taxpayers. Now on the input tax credit front, banks specifically have been given an option because banks, the larger part of their income would be an exempt supply, which is their interest income, which is separately exempted by way of an exemption notification. So in such cases, banks have been given an option under section 17(4), read with rule 32, to either opt for a 50% ITC reversal and not go in that 17(2) reversal read with rule 42 and 43. So the banks have an option either to reverse 50% flat of that input tax, of the entire input tax credit that they avail, or they can also opt to go by the rule 42-43 approach of the exempt and non-exempt reversal. That being said, this 50% rule applies only to the dealings with other parties, right? If their dealings are within the entity, that is dealings with their branches or distinct person, for such transactions, full input tax credit is available. The 50% restriction will not apply in such cases. Now, similar to valuation for Forex, guys, now option of this 50%, that also needs to be opted for the entire financial year. So if a bank has exercised the option of availing 50% credit, then they have to exercise it for the entire year or vice versa. And if they wish to change, they can change only in the next financial year. Now coming to the place of supply requirements. Place of supply in cases of bank, okay? So where the bank and customer is in India, the place of supply rule provides that the place of supply should be location of recipient of service that is in the records of the bank. So irrespective of whether you are registered or not, it says that whatever address is there in the records of the bank, that should be the location of the recipient in such cases. And where either the bank or the customer is outside India, in such cases, the place of supply for banking services will be the location of the bank itself. So say if there is a bank in India, customer is outside India, still even though my recipient is outside India, the place of supply will be in India, which is the location of the bank. And vice versa, if the bank is outside India and it is rendering services to a customer in India, then the place of supply will be outside India in such cases. Now, this broadly captures the applicable provisions for the banks, which are specific to banks. And now, on that note, having understood these relevant provisions, let us see how they are applied and what are the issues that arise, and how do you apply these provisions in these issues. Now, the first issue that we deal with is in relation to your normal savings bank account or the bank account that you maintain with the bank. You might have observed that there are certain banks or certain kinds of amounts where banks say that while you open an account with us, it is not a zero balance account. You will have to maintain certain minimum balance. Average minimum balance is required to be maintained. And if you fail to maintain such minimum balance, in that event, the banks will charge you non-maintenance charges. So the question that arises is what is the nature of such non-maintenance charges and whether they are taxable under GST, whether it constitutes a supply or whether there is a consideration involved and whether they are taxable under GST. That being said, we can understand that where a minimum balance is not maintained, banks levy non-maintenance charges. But another issue that has arisen, what the GST authorities are alleging, is that even in a case where someone has maintained that average minimum balance and at no point in time the average minimum balance goes below the permissible limit, even over there the department is seeking to charge GST as computed on the notional non-maintenance charges by assuming that had the balance fallen below the permissible limit, what would be the non-maintenance charges that would have been charged, and they are seeking to charge GST even on that element. Now that is about the issue. Now let us fundamentally understand that what is the nature of this average minimum balance charge, right? So if I look at it from a contract law perspective, the contract or the agreement between the customer and the bank is the understanding is that the customer has agreed to maintain that minimum balance at the time of opening that bank account. Now, in the event such balance goes below, is there any supplier or consideration involved, or are such charges penal in nature, and therefore it cannot be treated as a consideration towards any supply? Now, the biggest hindrance over here comes is that the department would allege that this is an activity of agreeing to tolerate an act, and therefore it is liable to GST. But there is a circular 178 that has been issued by the CBIC. That circular says that if any damages, liquidated damages, etc., that are charged, or any penalty that is charged, that does not constitute a consideration towards any supply, right? Because the normal, as per the contract law, the intent is to continue the contract, or intent is to perform the contract. There cannot be any intention that the contract is not to be performed, and therefore such charges are to be looked at from that perspective, because it does not amount to tolerating an act, but this is to prevent that not tolerating an act. So it is in fact not tolerating an act, in fact not tolerating an act, and therefore it is in the nature of penal charges. So the circular goes on to clarify that liquidated damages or penalty are not in the nature of consideration towards any specific supply, because the intent is to continue the contract and not to breach it. And on this premise, they have said that such charges will not be treated as consideration, and the banks can take this argument to say that such non-maintenance charges are in the nature of penal charges, and therefore rely on the circular to say that they'll not be taxable to GST. Now we come to the second issue, where they are saying even where it is not going below the average minimum balance, that it is to be taxed at a notional value of the non-maintenance charges. In that case, firstly, there is no agreement to supply. In fact, there is even in the contractual arrangement, there is no clause which says that, if you maintain the average minimum balance, you will still be required to pay certain charges. So without that particular contractual clause being there cannot be a notional supply without an agreement being there in the first place. So that contention of the department seems to be baseless on that front and has no legs to stand, because there is no agreement in the first place, which is the first and foremost criteria for an activity to qualify as supply. So that is on the average minimum balance bit. Next we come to administration charges. So this is on the activity of the bank of granting loans and providing finance. So at the time when a loan is granted by the bank, we might have noticed that banks, apart interest is charged on the EMI, etc. But banks, while granting or disbursing the loan, at that point of time, they charge certain processing fees, documentation charges, etc. And as we know that the main consideration for providing finance is interest, but these are in the sort of in the nature of administration charges that the banks will charge you at the time of granting the loan. The question arises that while interest income, which is the principal activity or the principal consideration for granting funds, that is exempt, whether such administration charges will be taxable or not. On that front, one thing that needs to be noted, that the exemption clearly is only for interest, and interest is something that is computed in percentage terms on your principal amount. Now, this processing fees, documentation charges and all are over and above the interest, and per se are not in the nature of interest, if one were to say, because they are not payable regularly, they're not computed as a percentage of the principal amount, so on and so forth. So therefore, the first view that emerges is that such transactions are not covered by the exemption and therefore should be taxable. This similar clarification has also been given in the Service Tax Education Guide, where they have said that such charges should be taxable. However, when we say that, another interesting aspect to note is the provisions of Section 15. Section 15 first says that the value of supply should be the transaction value, which is fair. So the transaction value of granting loan, the transaction value of or use of that money is the interest that I charge. Then when we read Section 15.2, it provides for certain inclusions. And within that inclusions, it says that any other charges, etc., can be added to the is to be added to the value of main supply. So is there might be a possibility to say that these because my principal supply, that is use of money in the form of interest, is exempt. Even these processing fees, documentation charges, etc., are nothing but my activities and towards the main service of granting the loan. And someone might attempt to take that argument that even these should be exempt. However, you need to exercise abundant caution in that, because it would be a very aggressive view, because the clarifications, etc., are against you, and the processing fees, documentation charges, etc., do not fall within the purview of interest. Also, applying the concept of composite supply would not be acceptable in this case, because composite supply requires presence of two or more taxable supplies. So even if I were to take an argument that this entire bundle is a composite supply and the principal supply being exempt, they should be exempt, that might not fly, because composite supply itself requires existence of two or more taxable supplies. Therefore, our view is that administration charges that is levied by the banks would suffer GST, and therefore banks should discharge GST on that. Next, we come to another aspect of these loan services where the banks have granted a loan. Now, when the banks disburse a loan or where they grant a loan deal, the loan is granted for a particular tenure. And the normal expectation is that the borrower will continue the loan for the entire tenure. And therefore, if I intend to foreclose or prepay my loan, banks levy certain prepayment charges in that event. Because if we may look at it that way, the banks, while they are doing their budgeting and their planning, they would factor in that this loan would be continued for an entire period, and therefore they would earn certain, their forecast, etc., will be based on that. So banks are inconvenienced if I go and prepay my loans, because they are deprived of that much income, because I would end up paying that much lesser interest. Had I continued my entire tenure of loan, I would have paid interest for a longer period. So banks are deprived of that additional consideration, and therefore they charge these prepayment charges or the foreclosure charges. Now the question again arises is whether these prepayment charges or foreclosure charges, whether they are taxable and leviable to GST or not. Again, as discussed earlier, the department might try to fit this in the services of agreeing to tolerate an act, because when the banks are agreeing to close your loan account earlier than expected, at that point of time, they are tolerating an act. However, again, as taxpayers or banks, reference and reliance can be placed on this circular number 178, which we discussed, which is the liquidated damages circular, and where they have said that in the event of any damages for breach of contract or any penalty for breach of contract or for non-performance of a contract, it will be treated as in the nature of penalty and therefore not in the form of consideration, and therefore they should not be treated as supply, because the important element that supply requires is consideration, and without consideration there can be no supply. Apart from the circular 178, there is also a circular 245, which again goes on to clarify specifically that in case of penal charges, GST should not be leviable. So these are the two circulars which are in favor of the taxpayer, namely the banks, which can be resorted to if in the event the department says that prepayment charges are to be taxed, because the short point being they are penal in nature and are sort of in the nature of damages for the inconvenience suffered by the bank. Next, we come to another aspect of the loan. So while we have discussed what happens in case of prepayment of the loan, let us see what happens when I default on the EMI payment. Because as we mentioned earlier, the contract or the arrangement between the bank and the borrower is that the borrower will pay EMIs for the entire tenure of the loan, and as on the due date. Now, when the customer defaults on paying that EMI, banks charge certain penal charges for this. So the question arises as to what is the nature of these penal charges and whether they would suffer any GST on this. Earlier, banks used to also levy penal interest, but as per the RBI regulations now, the banks are not are restricted from charging any penal interest, and any default of non-payment of EMI will be in the form of penal charges. And therefore, I've kept the discussion on penal interest out of this, but if at all it arises, the same arguments will prevail over there as well. Similar to your earlier discussion, again, the department's argument would be that this is an agreement to tolerate an act, and therefore it should be taxable. There was an AR in the case of Bajaj Finance Limited, specifically on this issue, which is against the taxpayer, which says that a GST is to be levied on such transactions because it is agreeing to tolerate an act. And even FAQ number 45 issued for the banking sector, that also echoes this argument that on penal charges, banks are required to pay GST. Now, our argument over here can be twofold. One is we can rely to that same circular 178 on liquidated damages and take those same arguments that we took for prepayment charges and say that these are in the nature of penalty and therefore not a consideration and not taxable. Other argument is found in our section 15, which is on valuation. So 15.1 says transaction value, 15.2 says that any addition in value or inclusion in value by way of interest or penalty, it should be added to my value of main supply. Now, if I were to apply that, what is my main supply and what is my consideration for the main supply? It is nothing but the interest, and the transaction value is the nothing but interest. And these penal charges can be looked at as an addition in value or the inclusions provided in section 15.2, which says that penal charges and interest should be added to the value of supply. So therefore, I apply 15.2 and go on to add this value to my main supply, that is interest. Now, no sooner I add it to the interest, it anyways becomes exempt because interest is exempt. And if I add it to interest, there is again no tax liability that arises over here. While because most of the banks adopt the practice of reversing 50% ITC, therefore, even if my value of exempt supply is enhanced, it would not make a difference on my ITC reversals. But if I have opted to go down the route of opting for the 42-43 reversal, then in that case, this might impact a little bit because this enhances the value of my exempt supplies and thereby resulting in higher reversal. Now, while we have discussed about this from a perspective of granting loans, what would be the situation of penal charges that are levied by the banks on defaultive payment for credit cards? Now, we all know that the exemption for interest on loans and amounts being advanced is only for the loans, is particularly excluding the credit cards, interest on credit cards, and therefore the banks are not able to obtain exemption for any interest that is levied on the delayed payment of credit cards. So therefore, whether will this argument apply, because this 15.2 argument would fall flat in that case, because any addition that comes will be the addition to my main supply, which is taxable. So if I'm paying any interest or any penalty, it gets added to my value of main supply, which could either be in the form of the annual charges that I pay for credit cards, or if I'm paying interest becomes my principal element and the penalty being ancillary to that. So they all get added to a non-exempt supply, and therefore it is taxable on the tax is leviable on the entire value. However, even over there, an argument can be taken that these are in the nature of liquidated damages arising from a breach of contract or in the nature of a penalty, and therefore no tax should be payable. So again, resort can be made to this circular to say that because it is amounting to a certain damage that bank suffers and it is in the nature of penalty, no GST should be levied because it does not result into any supply in the absence of any consideration. Next, we come to another interesting issue, which is on the correspondent banking services. Now, in case of international transactions, particularly in an export and import transaction, let us take a situation where there is a customer in India who undertakes export supplies. Now, when he is undertaking export supplies, he has to receive the money or the consideration from outside India. Now, because this customer might not have any bank account outside India or might not have any person where he can receive payment, and even as per FEMA, he's required to bring that money into India. There is no avenue for him to directly bring this money into India. So the customer approaches the Indian bank, and he will say that, look, I'm undertaking this export transaction and I need to bring this money into India, and he'll submit those export related documents to the bank. Now, in turn, what does this Indian bank do? Indian bank approaches a foreign bank with whom they might have a relation, which is called as a correspondent banking, and where they would have their own account, which is called as a nostro account, which an Indian bank maintains outside India. They would submit these export related documents to the correspondent bank. Now, the correspondent bank studying those documents, and they might have their customer outside India who would make payment to them, who would issue a check or in whatever manner. They would collect this amount and they would deposit it in the nostro account of the Indian bank. And the Indian bank thereafter would make the remittance to the customer in India. They will get the money from outside India into their account, and from their account, they make a credit to the customer's account or pay the customer by any other suitable means, either within the same bank or it could be an account in another bank. Now, the question that arises when the correspondent bank or the bank outside India remits this amount or transfers this amount to the Indian bank, they would not transfer the entire amount. They would reduce their charges, their facilitation charges or their bank charges. They'll reduce that amount and remit the balance to the Indian bank, and the Indian bank will thereafter make the payment to the customer by if there is their own charges, they will charge their own charges and thereafter remit the balance to the customer. So the issue involved over here is whether there is any service rendered by the foreign bank to the exporter in India, which is the customer of Indian bank, or whether the foreign bank is rendering services to the Indian bank. So the issue that arises, the department is trying to take this interpretation that the Indian bank is only facilitating the transaction of the Indian customer, and it acts only as a facilitator for the recipient being the exporter in India, and therefore it is the recipient in India who should be liable to pay this tax. But the situation is different over here. As mentioned, the account that is maintained in the foreign bank or the correspondent bank, that account is of the Indian bank. The Indian bank maintains that account, and the privity of contract also exists over there between the Indian bank and the foreign bank. Apart from that, under the GST law, recipient has been defined as the person who is liable to make the payment. Now, in such cases, who would the foreign bank consider as the person being liable to make payment? Because the foreign bank will have no wherewithal or no relationship. They would not even know who the exporter actually is, and they would have no connect with them. So the foreign bank would expect such consideration to be received only from the Indian bank, and therefore, even applying the definition of recipient, the person liable to pay becomes the bank, and it is the bank who is in turn the recipient of such services. And therefore, if reverse charge, if any, on import of service is to apply, it will be applied only on the Indian bank and not to the customer of the Indian bank or the exporter who's exporting from India. Because the service that the exporter avails is from the Indian bank and not from the foreign bank. And anyways, those charges, the Indian bank, whatever charges they'll charge to Indian customer, they'll anyways be factored into the GST as a domestic supply. Therefore, on this correspondent banking aspect, it becomes very important to understand the exact nitty-gritties of the transaction, because it is as such not the direct transaction between the exporter and the foreign bank. There is a person in between whose services are being availed by the exporter, and to provide those services to the exporter, Indian bank is in turn availing input services from a foreign bank to render its output service. And therefore, in clear terms, the recipient over here will only be the bank, and the liability to pay reverse charge, if any, will only be with the Indian bank. Next issue that we come across is now, while we spoke about loans and all, now banks at times to manage their liquidity, etc., they sell or assign those debts. So if a bank has a loan book, they would transfer this loan book to another bank or to an NBFC at a discounted value. Now the arrangement could be either they would retain some interest spread, they might not retain interest spread, and they would transfer it to someone else, thereby assigning that very debt to another bank. Now, this assignment of debt could be for either a secured loan or an unsecured loan. Right? Now, what happens? So there are the arguments for both are a little different. The question obviously is whether such assignment or sale is taxable or not. Now there is a concept of actionable claim. Actionable claim under GST, they borrowed the concept from Transfer of Property Act. And the Transfer of Property Act says that actionable claim is a claim to any debt. But which debt? It is a debt which is other than a debt which is secured by mortgage, hypothecation, or pledge. So in other words, a secured debt or secured loan is not considered to be an actionable claim, but a claim to any unsecured loan which is not secured, that can be considered to be an actionable claim as per Transfer of Property Act. And under the GST law as well, actionable claims other than lottery, betting, and gambling are considered to be not a supply because they are covered by Schedule 3. And therefore, for unsecured loans, I can take this argument if I've assigned the unsecured loans, then it is an actionable claim and therefore there is no supply over there. But now, what happens in case where the debt assigned is a secured loan? Now, the definition of goods and services, they exclude securities from the ambit of either goods or services. And securities also include derivatives. And the definition of derivative also includes an instrument which derives value from a debt. So therefore, an argument can be taken that even for secured loans, it will not be taxable because it is in the nature of derivative, and therefore it is neither a supply of goods nor a supply of service, and therefore it should not be taxable under GST. This position is also endorsed by the banking FAQ in FAQ 40 and 41. Next, we move on to sale of repossessed assets. Now, this was a very contentious issue in the erstwhile regime, in the VAT and service tax regime, and this issue at present is pending before the Supreme Court. However, it is relevant even today because let us see what happens under the GST regime where both the VAT and service tax laws were merged into one. Now, basically, what is sale of repossessed assets? If I have taken a secured loan and if I default on my loan payment, the banks can repossess those assets, and to recover their the funding that they've provided to me, they have the power to sell those assets and recover their amount. So therefore, the question that arises when the bank sells such assets, let us take an example of a motor car. If I have failed to pay the loan of motor car, the bank can take the possession of that motor car and sell that asset, and that is permissible in terms of the SARFAESI Act also. So now the question as to whether sale of such asset can be taxed in the hands of bank. The first argument that comes across is that the bank never takes title of those goods. It is merely taking possession and disposing it on behalf of the owner of the asset, so that the owner of the asset can make payment of the loan. So title is not transferred, and if the bank itself does not have the title, it is not in a position to transfer any title. So the first argument over here is that in case there is no transfer of title, there can be no supply, and therefore such transaction should not be taxed in the hands of the bank. Now, this also finds support in the SARFAESI Act, where SARFAESI Act says that the banks only take possession of the asset in the case of default, and they make such transfer on behalf of the creditor. And it also goes on to say that such transfer should be treated as if the transfer was made by the owner and not by the bank. So even if we were to resort to the provisions of SARFAESI Act, we have good enough arguments to say that the bank is not the owner and it is not in a position to supply these assets, and therefore such sale of repossessed assets cannot be taxable in the hands of the bank. Next, we'll come to the insurance sector, but I'll just see if there are any questions on this, which if they require to be dealt with in this at this juncture. At NBFC has various fallen of customers and now so they are now routing this loan through cooperative credit. Okay, how can we? So I think I'll do one thing, because I'll have to read through all the questions and understand what the exact question is being asked. So rather than spending time right now, we can take up the questions at the end because they are quite detailed questions. So I'll just begin with the insurance sector, and be rest assured that towards the end, we'll deal with the maximum possible questions. Now, coming to the insurance sector, right? So let us first understand what is insurance. Insurance is nothing but a contract to cover the risk, right? So if someone wants to cover a risk, they will approach the insurance companies. They'll pay the premium, and they would say that, look, if I suffer any loss, the insurance company will compensate me for loss. Or if I suffer any loss on the happening of an uncertain event, then you will compensate me for that loss suffered. So basically, the insurance companies, they assume risk that of their customer, and on the happening of certain event, they are required to give the insurance claim to their customers. And so that is why it is called an assumption of risk by the insurance companies. And the person who provides insurance is called insurer, and the person who takes insurance is called the insured. Now, the insurance scenario in India, there are two kinds of insurance. Largely, the insurance in India is divided into life and non-life sector. So there is life insurance, and any insurance other than life is referred to as general insurance. Now, within life also, there are four kinds, largely four kinds of life insurance. One is the term plan, where the risk assumed is only for the term of your life, and you become eligible for insurance claim only on the death of the insured, or in case of certain disabilities. Then there are certain unit-linked insurance plans, uh, uh, which which apart from giving you a life cover, also give certain saving options. So the premium in that case, some portion of the premium is towards the life cover, and some portion of the premium is towards a savings or an investment option. Endowment is also similar to that. And annuity is a kind of insurance product where you pay the premium for certain number of years, and after expiry of certain number of years, you will get a certain fixed amount for certain number of years, either if you're living, and on death, obviously you get the insurance claim. So that is largely the kinds of life insurance that we see in India. General insurance is any insurance other than life insurance, so which is your motor insurance, fire insurance, health insurance, marine insurance, and others. So any insurance other than life insurance is covered under the general insurance business. Now, similar to banks, insurance companies also have a similar set of rules, barring the input tax credit one. So time of supply is governed by Section 13. So I'm going a little fast over here because these are only provisions, and which I think they're general provisions which most of us would be aware of. So in the interest of time, I'll just rush through these slides. Valuation is again as per Section 15. 15.2 provides for inclusion of value. There are also certain specific valuation rules for life insurance policy, which we'll come to shortly. Invoicing, again, similar to banks, it is the same set of rule that applies. It's enhanced time limit of 45 days is available even for insurance companies. Now, in input tax credit, the benefit of the 50% ITC reversal is available only for banks and financial institutions. Now, insurance companies are not per se financial institutions, and therefore they cannot take the benefit of the 50% reversal, and therefore an insurance company, when they're making both exempt and taxable supplies, they will be governed by the provision of Section 17 and reversal as per Rule 4243. Then there's also a blockage on insurance services. So input tax credit is blocked on insurance of motor vehicles. Those motor vehicles for which the input tax credit itself is blocked. If the credit is not blocked, then even the insurance premium credit is available. Also, premium paid towards life insurance and health insurance is blocked under Section 17(5). Now, in the place of supplies, if the insurance company and the customer are both in India, now if the insurance services are supplied to a registered person, then the place of supply such is of the registered person. And if it is to an unregistered recipient, then the place of supply is that address which is available in the records of the insurance company. When either the insurance company or the customer is outside India, the recipient rule applies, and it will be the location of recipient which will be the place of supply. And for that, you can refer to the definition of location of recipient. It could either be the place of residence or the usual place of residence over there. Now, quickly coming to life insurance, we've covered it in the previous slide as to what life insurance is. The types of insurance also, these four kinds I've explained in the previous slide itself. However, it might be noted that there are certain life insurance business, particularly those life insurance schemes which are run by the government. They are most of them are exempted by notification 12, which is the services exemption notification. Now, coming to the valuation rule, which was referred to in the previous slides. For insurance companies, where apart from providing life cover, there is also certain savings or investment opportunities or investment related functions being given. In that case, the special valuation rules apply. In case of term insurance policy, which is purely a life cover and there is no savings options given, these rules don't apply and they're taxable at the full value. Now, coming to insurance policies that are linked to certain investments, over there, the rule is very simple. It says that you pay tax on that portion of premium which is towards life cover and you exclude the amount that is towards investment and savings. So therefore, the tax is only on the premium that is the component of premium that is towards the life cover. In case of single premium annuity, they are saying that it should be the 10% of the premium is what is the taxable value in such cases, and the 90% will not form part of the taxable value. For other insurance policies, which might also have a savings element, is that in the first year, the value of supply is 25% of the premium, and in the years going forward, they'll be taxed at 12.5% of the premium amount. Now, a question over here that arises, and in respect of which a clarification has also been provided. It says that now this exclusion, when I'm saying that only a 10% premium or only a 25% of premium is taxable, what happens to the balance amount? Is it considered to be an exempt supply or is it not a supply? What happens to that? Whether if it is exempt, do I have to do reversal on that or not? So this has been addressed by the circular number 214, which says that the definition of life insurance itself under the Insurance Law, Insurance Act, the definition of life insurance itself includes ULIP policies and other policies. Therefore, such kinds of products, ULIP, even though it has an investment angle or a savings angle to it, they are still considered to be in the nature of life insurance policies. And no sooner you're saying that they are life insurance policies, and the law itself has provided certain valuation mechanism. It has so the point to note here is it is a valuation mechanism and it is not a partial exemption that has been given under Section 11. Therefore, if that valuation mechanism is given, then you charge tax only on that value that the law determines. And therefore, even when you're paying tax only on the 10% of the premium amount, the balance is not to be treated as exempt. It is just not suffering any tax and therefore will not go. It is neither an exempt supply or a non-taxable supply on which reversal is attracted. Next, we come to a situation of typically the motor insurance products and the health insurance products. A question over here arises as to who's the recipient of services. Now, what happens is in a motor insurance claim, when I have to make a claim, so motor insurance is given that if there is any accident or any damage to the vehicle, that will be covered by your insurance policy. And in that case, there are again two options available to me, either a cashless facility or a reimbursement facility. In a cashless facility, I'm required to go to a service station, which is under the network of that insurance company. So insurance companies separately enter into a network arrangement with these service stations. And if I go to those particular garage or service station, I don't have to pay any amount or to the up to the cover amount, and the insurance company will directly settle it with the garage or the service station. In the reimbursement mode, however, I get my car serviced. The insured, that is the motor car owner, first makes the payment to the garage and then it claims a reimbursement from the insurance company. Now, this service station could either be a network service station or a non-network service station. Similar things apply into health insurance as well, where you replace the car with the patient who goes to get treatment from the hospital. And in case of network hospital, it is settled directly by the insurance company. In case of reimbursement, similarly, the patient will first make payment to the hospital and take reimbursement from the insurance companies. Now, the issue that arises, who is the recipient of such insurance service? Whether it is the insured or the person who goes to get his car repaired or the person who goes to take a health treatment from the hospital, whether he is the recipient or he is merely the beneficiary, but the recipient is per se the insurance company, because even if we go to see the definition under the GST law, recipient is the person who is liable to make payment. Now, when we talk about particularly in the case of a cashless scenario, we need to understand that while on the face of it as a insured, there is only this insurance policy that is existing between me and the insurance company. But in the background, the insurance company enters into these network agreements with the service stations and with the hospitals in case of health services. And these network agreements in detail lay out the criteria, the nature in which, the manner in which these services are provided, the quality of services that is required to be provided. All these things are are covered in that network agreements where the insurance company itself lays down those criteria. Apart from this, when I have a network agreement, the liability to make payment to the garage or to the hospital is that of the insurance company. So even while the services are customized by the insurance company, that is one of the things that we look at. Even the person liable to make payment is the insurance companies in such case, and therefore, if I was to look at it in that sense, the recipient becomes the insurance company in such cases, and the person who goes to repair his motor car or goes to get the health treatment is only a beneficiary of such services. Now, in case of motor insurance, this issue has been clarified in the circular. They say that where there is a cashless scheme, you can take the insurance company is the recipient provided the invoice is issued in the name of the insurance company. And even in reimbursement, they go on to clarify that insurance companies will be the recipient because provided the invoice is raised by the garage on the insurance companies. Now, because for motor insurance, this controversy existed in the service tax regime, the manner in which they function, they have their practice, the practice between the insurance company and the garage is that the invoices in such cases will directly come to the insurance companies. Unfortunately, in the case of health services were never taxable. They only became taxable in GST to the extent of those room charges. There was an amendment which came in which says that exemption for health insurance services, healthcare services will not be available to room charges if they are over and above 5,000. So that is the first point in time when health services have been brought into the tax net, and therefore there is no such set mechanism that has been followed by the hospitals of giving the invoice to the insurance companies. And as of date, unfortunately, there is that set practice is absent. Apart from that, even under section 17(5), there is a particular carve out for motor insurance, which says that if a general insurance service is given in respect of motor vehicles, which for which the credit is not blocked, then such credit will not be blocked in the hands of insurance companies. So first hurdle that arises as to who's the recipient. Recipient, because insurance companies are liable to make payment, they become the recipient. Second hurdle was the 17(5) blockage, which in case of motor insurance companies has been resolved. But to date, we do not see a similar concession given to health insurance companies where credit is available, because if we see 17(5), credit on health services is blocked. With that being said, the argument that could be available to the insurance companies over here is they could say that the blockage is for health services, and the services that they are receiving or the services that the hospital is providing is healthcare services. Now, these two terminologies are used in the GST law. While 17(5) uses the term health service, if you go to the rate notification and exemption notification, they use the term healthcare services to define the services that are rendered by the hospital. So the insurance companies can attempt to take this view to say that the blockage is only for health service, healthcare services something different from health services, and therefore blockage is not applicable on that. And health service over here would cover services of gym, nutritionist, etc. That is the kind of argument that could be taken by the insurance companies. However, the only drawback is the practice followed. The hospitals as of date are not issuing invoice in the name of insurance companies. They issue the invoice to the customer. So therefore, the insurance companies need to change this practice and factor this into their network agreements with the hospitals. If they are able to do that, at least the hurdle of being the recipient of service could be crossed, but still the hurdle of 17(5) would remain. And to cross that hurdle, possibly an argument could be taken to distinguish between health service and healthcare services. But again, that will be a very uphill battle, and therefore insurance companies should as such represent these issues to the government and get a similar concession even for health insurance companies, because this practice has been adopted for motor insurance companies. And also one important point to note, like when in the service tax, this concession or the judgments were made in favor of motor insurance companies, that was given by resorting to a circular which applies to a health insurance service. So therefore, looking at the entire scheme of things, the health insurance companies should also rightly be available for this benefit, and it is only fair that they represent this issue with the government. Next, we come to group insurance policies. We might have heard of various group insurance policies, particularly in an employer-employee scenario. where all the employees working for an organization, the organization provides health insurance to them, which is either part of CTC, and also the employees are given an option to add for additional cover by making certain payments. Those are the kind of employer-employee groups where a group policy is between employer and employee. Then there are other group insurance policies which are non-employer-employee, which is so a typical example over there could be say a credit card service. So you might have noticed that when you take credit card, there is a certain insurance that is given to the credit card holder. So that is one group which the credit card company makes. Then there could be a example of the insurance, maybe the ICI insurance that is given to all of us. That could also form part of the overall group policy where the group manager is ICAI, but it is not an employer-employee relationship. So there are these two types of group insurance policies, and as per the IRDA guidelines, there are different rules that apply to them. And therefore, if there are different rules applying to them in the IRDA guidelines, even the GST implications would be dependent on them. Now, when we talk about employer-employee groups, the IRDA guidelines on group policy, they name the employer as the policy holder. So IRDA guidelines says that it is the employer who is the policy holder. It also says that employer is issuing only a confirmation of insurance. So they are only required to intimate their employees that look, you're covered by this insurance policy which the company has taken for you. And they say that this group insurance is only as a service benefit. Now, when we read this for a non-employer employee group, the IRDA guideline says that the group manager, that is in our case either the credit card company or ICI, they only act as a facilitator. That is, they are only merely acting as a conduit in making those services available to the actual insured. And in that case, the group manager is also required to issue a certificate of insurance to the group member. Meaning, so the parent child policy could be with the group manager, with the credit card company, but they would be required to issue a certificate of insurance, which is a child policy, which goes to the actual insured. And they also say that the employer is recipient of service and is the policyholder in case of employer-employee groups. But in case of non-employer-employee groups, they only refer to group manager as a third person, and they frame it in a way that the group manager is only a conceptualizer and is not actually availing those services. Now, in this background, what happens? Whether this is liable to who will be the recipient of service, whether it is the employer in a group policy or in a non-employer employee group policy, whether it is the group manager or the actual beneficiary or the insured. So while we have seen in an employer-employee related group policies, very clearly the IRDA guidelines refer them to as a policy holder. And in such scenario, when an insurance company transacts with an organization, it typically expects the employer to make the payment, and therefore the employer is liable to make payment. However, a question arises: what happens to the additional coverage? Because employer recovers that. Employer recovers that from the employee and then makes the payment to the insurer. So in such cases, what happens is does the liability shift to the employee in relation to the additional coverage, or does the liability still remain, or does the recipient still remain with still recipient is still the employer in such cases? So what I'm trying to say over here is, while in a case of employer-employee group policies, the employee might be paying this additional amount to the employer, but this amount is to be routed only through the employer. So therefore, in the eyes of the insurance company, the person liable to make payment remains the insurance company. Because if the employer is giving a statement that, look, so and so employees are covered by my insurance policy and so employees have paid an additional amount to opt for the additional cover, even then the insurance company will seek to recover this amount only from the employer, and therefore the person liable to pay remains the employer, and thus the employer will be the recipient, and being the recipient, the employer could possibly claim input tax credit for that, and the insurance company will have to issue one single invoice to the employer and no need to issue separate invoices or separate policies to their employees. However, the situation will be different in case of non-employer employee groups. because over there, the IRDA guidelines say that the group manager is only a facilitator. Now, when I say that he's the facilitator, so he only acts as a conduit, and therefore the person liable to pay remains the actual insured or the group member in that case. And therefore, in such cases, the recipient would change and it would not be the group manager, it would in fact be the group member in such cases. So, therefore, this line of distinction needs to be kept in mind, and that one could only understand by referring to the IRDA guidelines. And now, reading the IRDA guidelines and the GST law together, the manner in which we treat two people as the recipient of services in group policies will remain different depending on whether it's an employer-employee group or whether it's a non-employer-employee group. Now, taking forward from here, particularly in respect of group health insurance policies, this issue has arisen where the department is saying when the insurance companies is supplying, rendering insurance services to a SEZ unit, whether they would be eligible to enjoy the zero rating benefit. Now, the Section 16 also underwent an amendment. Prior to amendment, there was no requirement for the supplies to be for authorized operations, and if I am able to fulfill the condition of the SEZ unit being the recipient, then those services were considered to be zero rated. But after the amendment, they have said that zero rating will be available only if you have made the supply to SEZ unit for authorized operations. Now, there is in case of services, the SEZ law has also come out with a list of authorized operations. And in that list of authorized operations also, if you notice, there is a general insurance business services which is covered. Now, as we discussed in the beginning of insurance section, we said that any insurance other than life is general insurance service. So therefore, a health insurance will also be considered to be general insurance business services. And having been covered by the authorized operations list, they should continue to enjoy zero rating benefits. Now, the other question that arises is whether the first hurdle that we have to cross is whether the SEZ unit is actually the recipient of service. Again, recipient of service, as we have been saying, it is defined as the person who is liable to pay. So, if I have contracted with the SEZ unit, and if the SEZ unit is liable to pay those pay for those insurance services, then they become the recipient of services. So, if SEZ unit is the recipient of services, then the zero rating benefit is available to me. So, prior to amendment, this situation was very clear. Now, the next question arises is whether these services are towards authorized operations. The argument that the GST department is taking over here, particularly for the post-amendment period, is that because you have rendered insurance services, which are actually personal in nature because they are for the health of the employees, they are not for your business, and therefore you cannot say that this is authorized operations. Now, this contention is being taken by them despite general insurance business specifically being covered under the authorized list of services. So at the first blush, we can say that, look, it is covered by the authorized list of services and therefore zero rating benefit should be available. But they're going a step forward and saying that, okay, fine, they might be for authorized operations. But as per Section 16 of CGST Act, you are required to fulfill the condition of the services being in the course or furtherance of business. And because these have a personal element and they are for the employees, they're not in the course or furtherance of business of the SEZ unit. Now, that being said, the particular issue arises over here because how do I justify that these services are for authorized operations? So the argument that can be taken over here is for other insurance services, say if I was to insure my plant and machinery, which for a manufacturing sector would be the most vital assets, the machinery, machinery line. Over there, they are not creating any problem, and they're saying, yes, this is for your authorized operations, and zero rating benefit should be available to you. But now, when I come to employees, if for a service sector, particularly for ITSEZs and all of those, my employees are my most vital asset. So therefore, it becomes very important for a company to ensure the health of their employees. And if I'm to compare that, even if I was to say that even employees are my assets to the asset to the company, then applying a similar logic that if a plant and machinery you're considering for authorized operations, In case of companies, the employees are also a very vital asset, and therefore a cover for their health is nothing but in the course of authorized operations, and it is intrinsically linked to my business. Therefore, it should be considered as towards authorized operations, and zero rating benefit should be available to me. And there are in the erstwhile regime, there were certain precedents that if such cost is added to the cost of production, then they are to be considered as in the course of that business. And therefore, if we would apply that logic also, we can take that argument that it is for authorized operations in this case also. And again, obviously, the test of essential character will also help us in this case to say that the essential nature is to provide insurance cover to the companies, because the risk cover for the employees is also as such on a holistic basis. If you see it is for the company and applying that test, the recipient becomes the SEZ unit. It also is required for their authorized operations, and therefore the zero rating benefit should be available if we are able to take these arguments. I've covered these question and answers. Due to the paucity of time, I'll just move on to other issues. Right. Now we come to another important aspect of the insurance sector. There is a concept of co-insurance and reinsurance. Let us first understand what is a co-insurance, what is a reinsurance, and then we come to the controversy therein. Now, co-insurance. So if there is a huge risk cover that insurance companies are to undertake, now a particular company might not be in a position to bear that entire risk. So what happens is all the insurance companies, they come together and they say we'll come together and we will assume risk in a specified proportion, right? And while doing so, they appoint an insurance company who should be the lead insurer, and the other insurance companies will be said to be the co-insurer. And now there is an agreement that has been entered into, or a MOU that has been entered into by all the general insurance companies, and as per which a lot of powers have been given to the lead insurers to transact on their behalf, to close transactions, to receive the premium. So they receive the premium, the entire premium, and then they distribute the proportion to the other co-insurers. And even at the time of claim settlement, they will collect all the respective claims from other co-insurers for their share of risk. They will collect it, and the lead insurer will disburse it to the insured. Now, this is how a co-insurance arrangement operates. And in this also, the issue that was arising is while the lead insurer will collect the entire premium and would discharge the entire GST on that, the department was saying that the attribution or the distribution of the share of premium of other co-insurer also results in a supply between the lead insurer and the co-insurer, and they were trying to tax that. We'll come to what the amendment has taken, what is the amendment in law in this regard. But before that, I'll just explain the concept of reinsurance over here. Now, reinsurance is another concept in insurance. Again, that is to basically dilute my risk, because again, reinsurance concept comes into the play when the insurance company feels that the risk is too large for me and I would not be able to bear the entire risk of this insurance product. So what the insurance company does is it will cede a particular part to the reinsurance company. Means it will say that, look, out of the entire 100% insurance of insurance cover given, you take 50% of this. So it will reinsure that 50% with another insurance company, and it will also cede the premium. So obviously, because that insurance company is assuming 50% of the risk, so they will also transfer that much premium to the reinsurance company, and reinsurance company will charge a reinsurance premium to that. Now, while they do this, while they charge the reinsurance premium, as a business practice, what happens is this reinsurance companies also, while the insurance company who has taken reinsurance, while paying the reinsurance premium to the reinsurance company, they will retain a certain reinsurance commission, and they will only transfer the net amount to the reinsurance company. Now, the logic over here is, while they retain that reinsurance commission, is because they are helping the reinsurance company to get certain business, and they are retaining, reducing that much amount from the reinsurance premium, retaining a portion of it as their commission. So this is how a reinsurance situation works. And over here also, for that reinsurance commission, while the reinsurance company discharges tax on the entire reinsurance premium, which also includes the portion of commission, the department was seeking to tax this reinsurance commission, which the insurance company adjusts, and was trying to levy tax on that. And subsequently, for both these co-insurance and reinsurance issue, an amendment has been made, but this amendment is only prospective in nature. So while we'll see what happens to the past period, let us understand what is the situation after the amendment has taken place. Now, both this share of co-insurance premium by the lead insurer to the co-insurers and the reinsurance commission portion, they have been included in Schedule 3 of the CGST Act, meaning that such activities are not considered as a supply of goods or services, and therefore the second leg, which is in case of co-insurance premium, second leg, which is the distribution of premium by the lead insurer to co-insurer, is outside GST now. And similarly, the second leg in a reinsurance transaction is the retention of the reinsurance commission by the insurance company has also been taken outside GST. The only condition attached over here that in both the cases, in co-insurance case, the lead insurer should have paid the tax on the entire premium, and in reinsurance case also, the reinsurance company should have paid tax on the entire reinsurance premium. So if these conditions are fulfilled, then these activities are considered to be not a supply under Schedule 3 of the Act and are outside GST. Now the question arises that this clarification is only prospective. What happens in the past period? So considering the situation, while GST Council had recommended this amendment, it considered the difficulty of the industry for the past period because varied practices had been adopted by the insurance companies. Some insurance companies had paid tax on it, some had not paid, and they were contending this issue. So they said that in such cases, the position that has been adopted by the taxpayers, being the insurance companies, will be accepted on an as is whereas basis. Means if you have paid a tax on this insurance premium or the share of insurance premium or on the reinsurance commission, then you'll not get a refund. And if you have not paid any tax, then no one will come and demand the tax from you. So that position was accepted on an as is whereas basis. But now, coming to think of it, the insurance companies who have discharged tax on that, it becomes unfair to them. So if at all they had made an under protest payment at that point in time, does this make them eligible for the refund is the question that arises, right? So now in dealing with this situation, the manner in which an insurance company who has suffered the incidents of tax in such cases, they can take the arguments of double taxation. They could say that, look, the entire co-insurance premium has been paid by the lead insurer, and therefore you cannot again come and collect tax from me. And if you have collected any tax, that is without the authority of law, and therefore you have to refund this tax to me. That is one of the arguments that they can take. Also, as per the co-insurance agreement that the insurance companies have entered into, if one looks into the now it is available in public domain. So if one were to do a Google search, they would get this co-insurance agreement. So if one were to read the terms of that agreement, the agreement is made in such a way that the lead insurer acts as an agent on behalf of the co-insurers. Now, when we say lead insurer as the agent, under the GST law, agent has been defined as a person who carries on business on behalf of the other. So we can take a situation that this lead insurer, to the extent of this co-insurance, is carrying on business on behalf of the other insurance companies and is facilitating by way of their agency services. The agent is also covered in a definition of supplier. So therefore, for the entire co-insurance premium, if the lead insurer is acting in the capacity of the agent, it also becomes the supplier, being the person carrying on that business on behalf of all the insurance companies. It has also become the supplier covered by the definition of supplier. Having been the supplier, if he discloses this entire premium in his GSTR1 as an outward supply and discharges tax on the entire amount, there are very good grounds to say that there should be no liability on the distribution or attribution of the premium after the lead insurer has collected that premium from the customer, and the attribution will remain merely a transaction in money at that stage because there is no underlying supply. Whatever supply was the agency function that I'm doing, and the lead insurer also charges a nominal amount of 0.5 to 1% in these cases, which is also covered under the co-insurance agreement between these insurance companies. And it would be a very good case to say that the lead insurer is only liable to pay tax on that agency commission that he's earning from the other co-insurance companies. Similarly, in a reinsurance case also, an argument can be taken that look, if the reinsurer has paid tax on the entire reinsurance premium, you cannot again charge that tax from me, because the department would try to take an argument that these are two separate supplies, where the reinsurance premium is being charged to assume the risk of my part of my insurance, and the commission is being paid because you are giving business to the reinsurance company. But if one were to study the agreement, this forms part of the one agreement, and someone can take an argument that it is only a condition to a contract. And being a condition to a contract, it should not be taxed, particularly when the entire reinsurance premium has borne the incidence of tax. You cannot once again come and tax a portion of it in my hands. So while from 1st November 2024, these have been brought into Schedule 3, and they have also been regularized for the past period. But if in an unfortunate event, if some insurance companies have ended up paying tax on this, these are the grounds they can possibly resort to claim a refund by saying that there is no authority to collect tax, and particularly the position is enhanced if the payments were made under protest. Now, in insurance product, there is another issue that comes into place, which is pertaining to time of supply. Now, time of supply is either the date on which I provide services, date on which I issue invoice. But if I'm receiving any advance, the time of supply triggers at the point in time that the advance is received. However, if some amount has been received as a deposit, then that does not get included in the time of supply. So now, if you were to apply this in the insurance context, now what happens? Let us take an example of a health insurance. Now, when I go to an insurance company to take a health insurance, I pay the premium upfront, but the insurance policy is not issued to me upfront. What the insurance company does is, like, they'll ask for certain disclosures, and to verify those disclosures, they'll ask you to undergo a health checkup, a thorough health checkup. And depending on that, if they see that the disclosures made by you matches it, and so the premium that I'm recovering from you matches with the risk that I'm assuming, because if I have certain underlying diseases or certain underlying conditions, the premium would be higher, and if I'm a healthy individual, then the premium would be lower in such cases. So therefore, after considering all these things, the insurance company will issue a policy only after that. But the amount is collected by them in advance at the time when I approach the insurance company. So the question arises as to what is the time of supply in this case. Is it when I have gone to the insurance company and when I've paid the amount, or is it when the policy is ultimately issued? At the first blush, obviously, the department will try to take a stand that you have received an advance amount, and therefore it is taxable upfront. Now, this is an example which arises in a health insurance setup. A similar situation arises in cases where I go for an extended warranty scheme of the insurance policy. So if I'm purchasing certain products, say an electronic item, uh, along with that, the OEM or the manufacturer will give me a certain warranty, say for a year or two. And after that, for the balance period, I take an extended warranty, which is covered by the insurance product. And so the risk is assumed by the insurance company. The risk commences only after the manufacturer's warranty expires. That is after the end of 1 year or 3 years, depending on the manufacturer's warranty. And then after that, it continues for another 2 to 3 years is the extended warranty, when the risk is assumed by the insurance companies. So in such cases, what should be the time of supply? Whether, because the insurance company will recover the premium from me at the first date when I've purchased the asset, and when I've taken the extended warranty, at that date itself, the premium will be recovered. So while the department will obviously try to take an argument that this is advance and you'll have to pay tax at the time you have received an advance, a possible argument that could be available to the insurance companies in such cases is, can I say that this is not an advance, but it is a deposit that I have to, particularly in case of a health insurance, that this is in the nature of deposit. And if I do not issue the policy, this amount becomes refundable to them. And if the policy is issued, this amount will be applied. So which is nothing but which has the elements of being in the nature of deposit. And if I'm able to take that argument that the upfront amount that I receive is in the nature of deposit, in that case, the time of supply could be pushed to the date when I actually issue the policy, or when I actually apply that amount towards the insurance product. Now, in this situation, when I'm talking about the extended warranty, what happens in a case when this extended warranty is again reinsured? While we spoke about what happens with the insurance company, now if the insurance company, as a step two, it says that a part of this risk I want to transfer to some other insurance company, and they reinsure this amount with another insurance company. So as a practice, what happens is the insurance company will pass a book entry in their books of accounts to record this transaction record this transaction of reinsurance. So the books of accounts will reflect an entry, but the invoice for such reinsurance services is issued by the reinsurance company only when the risk assumption begins, and that is the point in time when the insurance company also actually makes payment to the reinsurance company for this for ceding of the risk or for transfer of the portion of the risk. Now, while it might appear that the service has been rendered at the first instance itself, when I've passed a book of account entries in my books of accounts, that is the point in time at which service is rendered. It might so appear at the first blush, but we need to understand that these services of reinsurance are in the nature of continuous supply of services. Now, as per the concept of continuous supply of services, the time of supply is the date of issuance of invoice as per the milestone that is in the agreement, or the date of payment that is prescribed in the agreement, or the date of actual payment, whichever is earlier, will be the time of supply. Now, if I were to apply this concept of continuous supply of service, the reinsurance company issues an invoice at a later date. Contractually, also, the insurance company is liable to make that payment only at a future date, and therefore, even applying that as per the continuous supply of services principle, the time of supply gets pushed to the date of actual issuance to the insurance company, the date of actual payment by the insurance company to the reinsurance company. Therefore, if these kind of arguments are taken, the insurance companies might be in a position to justify the situation. However, if the insurance company and the reinsurance company are related, the time of supply provision provides that in such cases, if you have passed an entry in the books of account, then that should be considered as a time of supply. So in case of related party transactions in this, the time of supply will be the first date when the reinsurance contract is entered into, or that book entry has been passed in the books of accounts. Next, we come to the concept of retrocession. Now, retrocession is nothing but a reinsurance of reinsurance. So, as per the flow, the insurance company might pass on a risk to reinsurance company. Now, if the reinsurance company also feels that this risk is too large, a portion of it will pass to another insurance company, which is known as the retrocession concept. So, retrocession, also there were disputes as to whether that is taxable or not, because there is no particular exemption or no particular concession. So, over there it has been clarified that retrocession services are also considered to be reinsurance service, and the same treatment that applies to a reinsurance service will apply to retrocession. So if a reinsurance service is taxable, retrocession will also be taxable, and vice versa. Now, this particular issue also arises because of particular insurance services which are covered under the exemption entry. Now, what had happened when GST had come into force, the exemption services exemption notification gave exemption only to the insurance, the underlying insurance service in respect of certain agriculture and crop related insurance schemes, that is the weather-based crop insurance scheme and modified agricultural scheme, which was covered in the exemption notification. But then they realized that the range we have given, while we have given exemption to the insurance service, we have not given exemption to the reinsurance service. So if this premium becomes taxable, the premium that will be charged for these agriculture or crop related insurance will increase. So therefore, from January 2018, they gave exemption even to these reinsurance services. But the question remained open for the past period, that what happens from July 17 to January 18, what happens in such cases. But over there, while the exemption has come in only from January 18, the argument can be taken that reinsurance is also nothing but a insurance service. Because as we saw that general insurance definition or a miscellaneous insurance definition, it covers all insurance other than life insurance. So if I am saying it covers all insurance other than life insurance, so reinsurance will also be considered to be an insurance service. And if reinsurance is an insurance service, so reinsurance for or insurance for crop-based services will be exempt. So if I draw that line of arguments, then I can say even for the period prior to January 2018, reinsurance itself being in the nature of insurance of this crop-based will also enjoy this exemption. And the exemption that has come after 2018 is only out of abundant precaution, only to offer a fair clarification that even the reinsurance services are exempt. Next, we come to another issue, which is on the commission aspect. Now, this issue was picked up by the GST authorities, and the overall demand for all the insurance companies together has resulted in an alleged demand of more than 5,500 crores for the entire industry, entire insurance industry. Now, what is this demand about? Now, when insurance companies sell their insurance products to agents, they give certain commission to their agents. Now, as per the IRDF regulations, the amount of commission that I can pay to my agents is capped. So, before 2023, this cap was to 5%. After that, the IRDA also taking notice of the situation. They said that because to expand insurance business, the insurance companies are required to pay a higher commission to make it lucrative for their agents to sell their products. They increase this overall cap to 30%. So whether before 2023 or after 2023, IRDA regulations had imposed a certain cap, or even to date have imposed certain cap on the amount of commission that I can pay to the agents. Now, the department or the DGG authorities, when they went to the insurance companies and conducted their investigations, they found that the overall amount that is being paid to the agents is more than this 5% or the 30%, because they found that the commissions that were being paid were to the tune of 30% or 35% or even more. Now, while they might have not been entirely in the form of commission per se, there might have been other services that the insurance companies would have obtained from these agents, such as a business promotion service. So it could relate to display of standees at certain locations, or certain advertisements that you can doing, or certain manpower or payroll outsourcing that would have done. So they would have, so the number of line entries or the kind of transactions were increased, and the overall amount, if I would club all these activities that the so-called agent or the service provider to the insurance company provided, they took all these amount, they totaled it up, and they said that you're paying this to your agent who's notified as who's empaneled as your corporate agent, and the total amount that you have paid to them is more than this 5%, and therefore you are not eligible to take credit of the services that have been rendered to you. Right. So because the service provision was from the agent in the hands of insurance company, they are denying credit, because insurance companies are not suppliers of that service, but they have said that you are not eligible to the credit because you've not received the services only. And the foremost condition for claiming credit is that you should have actually received those goods or services. And because you've not received these services, you are not in a position to claim input tax credit. And their arguments for saying is that you have not received services, that firstly you've done an illegal act, and therefore there cannot be a supply, because you could not have by law made supply of these services or received these supply of services. And in certain cases, they have also taken a stand that you do not have appropriate documentation to prove the services. And therefore, because like, if you are saying that certain standees, etc., were installed, give me evidence of that. So now, if some insurance companies who are in a position to give pictures or give evidence, emails, etc., those positions were accepted. But in certain cases, because considering the volume, insurance companies might not be in a position to provide pictures for each and every location, or provide an email trail for each and every location or each and every place where a standee is installed. The department has said that you do not have appropriate documentation, and therefore, again, you're not able to justify the receipt of these services. Now, this is what the overall controversy is. But the point to note is their entire case is based on a violation of another law, right? So what have they resorted to? They have said that in the IRDA regulations, you are not allowed to pay a commission over and above this. But there is no such restriction under the GST law. So the question that arises, that does illegality of law affect or invalidate the tax treatment under the GST law? The answer would be no. Why the answer would be no? Because the GST officers have jurisdiction to only apply and interpret the GST law. They have no business to go and go into the nitty-gritties of a IRDA regulation or regulations of by the insurance authorities. That jurisdiction is only with the IRDA authorities. If the IRDA authorities would have initiated some inquiry, that is fine. But you as a GST authority cannot come to me and say that because you have paid a higher commission, or because you have paid a higher amount to your corporate agents, you have taken you have done an illegal act and therefore there cannot be a supply. So the GST department would have no business to say that, because firstly they don't have jurisdiction to implement the IRDA law. That being said, there are other arguments that the right to input tax credit, insofar as I'm actually able to justify that there is a supplier in existence. The supplier has also said that, he has rendered these services. And if an invoice has been issued, because the law requires me to be to just substantiate that I've received the services, I am in possession of invoice, and I have made payments to the to my supplier. So insofar as I'm able to fulfill all these conditions, my claim to input tax credit should not be challenged. Now, another argument that you could take is that while the suppliers have discharged tax on this, at that point of time, the GST authorities have accepted the payment of tax. And having accepted payment of tax, the GST authorities now cannot approbate or reprobate, or they cannot blow hot and cold that in one situation they say that, okay, where you have paid tax, it is taxable. If you accept that position, then obviously a natural consequence of that is that input tax credit should be allowed. By that very same argument, it justifies the position that I have actually received the services, because in one breath you are saying that the supplier has provided the services and therefore I am collecting the tax. So having said that, now you cannot say that I have not received the services, and therefore input tax credit should be available to insurance companies in such case. So while this is a large issue, it is still under investigation. It is still to reach the closure. But in the under the GST law, on the erstwhile service tax regime, this issue had come up, particularly in the case of ICICI Lombard and Cholamandalam Insurance Company. Over there, the tribunal has said that, once tax paid is accepted by the department, credit cannot be denied at recipient's end, and they rely on the landmark judgment of MDS Switchgear of Supreme Court. Relying on that, they have allowed the credit to these insurance companies. And they also have an observation that says that, look, if there is a violation of some other law, you cannot bring that into or deny this NVAT credit to the insurance companies. So the outcome of these judgments will also have a bearing in the GST regime, where the same arguments can be taken. That whether I've violated another law or not, that is none of your business. And if I'm able to substantiate the entire document trail, the payments being made, you cannot deny credit to me. That was on the overriding commission issue. Next, we come to the issue of salvage. Now, what is salvage? So the salvage concept is relevant in the case of motor insurance companies and in case of motor insurance claims, where the insurance companies provide cover on the loss that you suffer on your motor vehicle. So if your vehicle undergoes some accident or some damage, there could be two situations. One is that there is a total loss, that vehicle cannot be repaired, and it has no value at all. And it has no value at all. So in such cases, whether there would be any whether in such cases when the insurance company disburses the claim, whether they are actually taking possession of that salvage or that wreckage, which is the damaged car, which is not in a position to be repaired. So whether they first take possession of that salvage, or the ownership of that salvage remains with the insured or the vehicle owner itself. Now, why this becomes relevant to understand is that when insurance company, so this salvage, whatever, it might have some value while it is no longer in that car form, but it still possesses some value. And when that salvage is sold, certain amount is recovered. So now what generally happens is, insurance companies, while settling the claim, they would reduce the value of this salvage, whatever value it derives from the open market and whatever sale value it derives. The insurance companies will reduce that and transfer the balance claim amount to the insured or to the vehicle owner. That is the normal practice. But in some cases, what happens, the insurance claim is for the entire amount. They give the entire insured declared value, which is the value or the insurance cover that the car owner has. They give it to the motor vehicle owner or the insured without any deduction of the salvage value. Now, these are the two situations that arises. And in this context, a circular has also been issued. Now, what that circular says is that in case where you have the insurance company has given the claim after deducting the value of salvage, in that case, when that salvage is disposed of, the ownership having remained with the owner of motor vehicle, the insurance company will not be liable to pay GST on the sale of that salvage. But then they go on to say that if you have given the entire insurance claim without reducing the salvage value, and entire claim has been disbursed to the motor vehicle owner, in that case, what they say that now you become the owner of the salvage, and if you sell the salvage, the insurance company is liable to pay tax on that. But so now there is a certain issue over here, right? Because the entire premise on which they are saying that you do not pay tax on the sale of salvage where you are reducing that amount from the insurance claim, because over there they appreciate that the ownership is not transferred, the insurance company does not have ownership. But then what stops them from saying that, where does this come from, that the ownership of the salvage where I'm giving the full claim comes with the insurance company, because there is no formal transfer of title from the motor vehicle owner to the insurance company. That does not happen. And if I look at the insurance scheme as well, my agreement itself could be that my insurance cover is for the entire value and I'll not reduce that salvage value. That could be the very well be the commercial arrangement and the business reality. Now, when I am disbursing that amount, it is as an insurance claim. How can you say that a part of it becomes paid towards the salvage that you're getting or the damaged motor vehicle that you're getting? How do you read that into the contract? Because what happens is it is only an insurance claim that is flowing to the insured, and nowhere in the contract I say that the ownership is being transferred of the salvage, etc. So that itself, the commercial reality itself is different. There is no contractual arrangement. There is no formal document of transfer of document to title. The RC book, which is issued by, in case of motor vehicles, that also continues to remain in the name of the legal owner. So if you are allowing me, saying that the sale of salvage when I'm doing settlement on net basis is not taxable, the same logic should apply even in case where entire premium is granted without deducting the salvage value. That being said, the circular clarifies otherwise. So if someone wants to take a conservative position and wants to comply with the circular, or the insurance company could follow a practice where they always reduce the value of salvage from their insurance claim. So if on a conservative basis, someone wants to adopt a conservative view, then they can, if they have disbursed the entire insurance claim without deduction, then they'll become liable to pay GST on the salvage. But however, we have considerable arguments to say that without transfer of title, there cannot be a sale, which is something similar we discussed in the case of banks also when we spoke about the repossessed assets. Right over there also we said that because the bank does not have ownership, it cannot transfer that title. Those same arguments can apply over here as well, that without having the title myself, I cannot transfer the title to those assets. And taking these arguments, I can very well take a view that there is no tax impact on the sale of salvage. Now that brings us to the last portion, which is the no claim bonus. Now, insurance companies, while you might be in a possession of an insurance policy, there might be a situation where there is no loss or damage suffered by you, and therefore you don't make any insurance claim. So, in such cases, the insurance companies, to further incentivize and to ensure that the customer stays with that very company, they give a no claim bonus. That is a reduction from the premium that I pay in the next year, saying that, look, you have not claimed any policy, so I'm giving you a no claim bonus and I'm reducing your premium. Now, the question that arises is whether this differential amount, whether there will be any tax implications on that, whether there is any supply being made by the insured to the insurance company by way of agreeing to do an act or tolerating an act, or whether this no claim bonus amounts to a separate consideration which the insured is charging the insurance company, right? So now the arguments over here is that this forms part of the very same contract, right? And no claim bonus is issued by the insurance companies to lure and retain the customers. And it is nothing but in the nature of a discount, because see, again, no claim bonus is established right from the first day and right at the time when I give my insurance policy or raise the invoice for same. And therefore, a no claim bonus is nothing but a discount that I have offered, right? And this very aspect has been appreciated by the CBIC, and they've offered a clarification on these very lines that if there is a no claim bonus, firstly, there is no contractual obligation on the insured to not make any insurance claim, right? So there is no such agreement that if you refrain from making insurance claim, we'll offer you a no claim bonus, etc. It is just a measure of goodwill that they offer you a no claim bonus in your next year of insurance policy. And even if that fails, I can very well say that it is a discount which has been established before the supply is made or before the invoice is issued, and therefore as per section 15(3), that value of no claim bonus should be reduced from the value of supply itself. So therefore, even on no claim bonus, we have a favorable clarification that they should not suffer any tax in the hands of the insured. Right. And with that, I think that brings us to the end of our both issues on banking and insurance. I believe that we've been able to cover it in time, but there were a lot of issues that we dealt with, and at some places, it might so appear that I was a little fast. And if there is certain clarity that is required, I'm happy to address that. But my apologies, I had to go a little fast because I thought that everyone should benefit with the entire issues that I've covered, and at least there should be some take home or reference to those issues being made. But if there is any place where anyone wants me to clarify further, I'm happy to address that. And we can now we have some time for questions also, so we can
Yes,
take.
Rushil bhai, thanks. Yes, PPT you are going to share with us, and we will upload it on the website of WRC. There are certain questions on Q&A. So, Rushil bhai, if we go one by one, or also people wants your contact address. So, if you can again,
For sure. I'll do that.
Yeah,
Let's do that.
open the last slide.
Yeah, just do that. I hope
Please.
it's possible now. I'll just go through some
Yes,
questions.
yes. Yeah, please.
Yeah. Or the banking related ones. So first question is by Mr. Chintan Shah relating to NBFC. It says an NBFC has various small MFI customers, and now they don't want entire loan as their risk book, so they are now routing this loan through a cooperative credit who lends. However, the NBFC underwrites loan referred and evaluated through them. So the agreement of joint lending or co-lending and cooperative societies paying 30% of interest of the right. So this question by Mr. Chintan Shah dealt with by in the banking section where I said I spoke about assignment of debt. So while that assignment of debt, I said it could either be an actionable claim if it is for an unsecured asset, and it could be a derivative if it is towards a secured loan. That same arguments will equally apply even for an NBFC because the arguments remain same. The nature of transaction was also similar. Now the question on the interest spread, I think the question that is asking that certain portion of interest has also been retained. So that interest spread also, but it's still, because interest on loans, they enjoy an exemption, it still continues to remain in the nature of interest. And I believe that even that interest amount, whichever is retained by the original lender, that will also fall within the exemption entry. So both the interest spread retained by the original lender and the person to whom the debt has been transferred, both will continue to enjoy the benefit of that interest rate. Next question. Sorry, I'm just reading the question.
Yes, please. So next is from Simran Bojwani.
Okay, in one of the client case, we purchased the gift cards from the bank and supply those cards to various corporates as gift cards. The bank first issued the cards at fully loaded amounts, say 5,000. Later, they gave us cashback, which we considered as income. My query is, do we need to pay GST on this cashback received against the sale of gift cards? How to conclude this transaction? Right. So while we might have taken those gift cards, they are nothing but in the nature of as such a debit card which is given, but a limited validity debit card with a limited amount. My understanding is that you load a certain amount and there is a certain cashback that is received. So now if that cashback is factored in at the very time of loading that amount of 5,000, then one can take an argument that that is to be treated as a discount because that is established at the time of making supply, and it is nothing but a value which is given back to you. And this could be considered in the 15(3) exclusion, which says that discount, if it is established at the time of making contract, will be reduced from the value of supply. So I think that is one argument that you can take, that this cashback is nothing but it has the elements and attributes of a discount, and therefore it can be reduced from the value of supply.
And also a reduction in the purchase cost.
And a reduction in purchase cost, absolutely. Because anyways, the loading of amount and everything, that is a merely a transaction in money. So it does not suffer any GST.
Yes.
Uh,
So Chintan Shah has again asked some question. Can an exporter claim GST on charges for forex conversion, inflow and outflow of currency through Indian bank?
Absolutely. I think so. There is no restriction in claiming input tax credit on the bank charges. So these forex conversion charges are also in the nature of bank charges, and they are not specifically blocked by Section 17(5). And since you are making exports, even if say it is exempt for exports, you can take credit even if your supply is exempt. So I don't see any issue in claiming input tax credit for foreign exchange currency exchange charges or the margin that they levy.
Correct. So next question again by Simran Bhojwani. In case a machinery is damaged due to
Yes.
accident, the insurance company only reimburses the cost of part damage, which cost rupees 50 lakhs. However, the GST on same is not reimbursed. How to deal with the GST part in machinery in the books of the owner?
Correct. So, right. I mean, this is a valid question, but this actually is more on the commercial front. Now, that is your arrangement with the insurance company. And as per the insurance agreement, the insurance cover provided to you is only to the extent of 50 lakhs. And that insurance contract would have mentioned that, we'll not give you any GST cover for that. So, that is purely coming out of your insurance contract. And if the insurance contract itself says that GST is not to be reimbursed, I don't think that contractually there is anything that we can do. But if I want to understand, is there any GST aspect that is being brought in away? Is it pertaining to like any input tax credit related thing or anything like that? If
Yes, Kushal, I guess Simran, if you can unmute yourself and join
because from
the.
the question, it is purely a commercial arrangement between the insured and the insurance company, and the contract itself would not permit you to receive a claim for the GST element. We can come back to that question if.
Yes. Now, Kushal Mehta has asked employee insurance, not even SEZ department may argue. Employee insurance, not even SEZ department may argue not in course of furtherance. Yes.
Right. So whether SEZ or non-SEZ will not make any difference. But the issue over here is arising because when I make supplies to SEZ, they are treated as zero rated. And after the amendment, to establish that they are zero rated, I also need to fulfill the condition of them being in the course of authorized operations of the SEZ. And to substantiate that, I'll have to bring in all those arguments to say that the employee of the SEZ is also intrinsically linked to the business because him being in good health is of utmost importance to any company, and therefore any insurance cover of health that I give to the employee is nothing but directly connected to my business, and therefore zero rating should be available. So yes, the question is correct. It will not make a difference, but in SEZ, suppliers have to cross one added hurdle of being in the nature of authorized operations, and hence that entire discussion was relevant.
Yes. Next question is again by Kushal Mehta. Interest on loan advance by individual is exempt. Whether that individual is required to register under GST if he has other taxable income from other sources, whether is he required to register?
So now there are two aspects. The interest element, when you're computing aggregate turnover, it is not excluded from the exempt supply turnover, right? So when I'm computing my aggregate turnover, I'll have to include my exempt income, whether interest or not, and my other taxable income also. The only concession that is given for interest element is from reversal. They say that only for the purpose of reversal under 4243, you do not consider interest in that reversal ratio. But that same exception or that same exclusion is not there when you compute the aggregate turnover. So you'll have to include both exempt and taxable turnover.
Correct. Prakash Prajapati has asked, is group medical insurance not allowed ITC by GST officer? What argument we can take to defend our case?
Right. So same when we were dealing with the SEZ case, while we took those arguments to establish that they are in the they are for the authorized operations, those same arguments. So the officer might be having his reservations that these are not in the course or furtherance of business, which is one of the primary criteria required under 16 to claim credit. So you'll have to use the same arguments to say that employee is intrinsically linked to my business. Without the employee, I cannot carry on my business. So therefore, you cannot say that any health cover that I take for employees is
Out of ambit.
correct, is out of the ambit. But the only catch over there, while these arguments be taken, there is also section 17(5), which is specifically blocking this credit of health insurance. So that is where the credit denial by the officer would be triggered. So, and there is, as of now, as we stand, there is no relaxation on that.
Correct. I guess Simran has.
No, only Bhushan. Only if
Yes.
there is a binding on the specified in the law to take
Yes.
mediclaim, like it was there in COVID period.
Correct, correct. So those
So
then it's
ESI
allowed.
policies and everything, which are mandated by laws, yes, over there is exclusion. I agree. So that argument can be taken that because it is coming after 17(5)(a), that B after B and C, so that explanation applies even to the health insurance bit. So if it is mandated under any law, then yes, we can take that argument that because it is mandated by law, due to the specific exclusion, that credit can be taken.
Yes, and Simran has now elaborated that her concern as the machinery part is damaged would be ineligible to claim the ITC of the GST paid on that 50 lakhs. So, though the same has been reimbursed by the insurance company, if there is a damage, then whether
Correct.
they are required to reverse or not.
Right. So what will happen in such situation? While when you would have purchased the machinery, you would have taken the input tax credit of that. Insurance, then the machinery got damaged or destroyed, the insurance company gave you that insurance claim of 50 lakhs. But now when this machinery is damaged, you will be removing it from your premise, you will be selling it or you will be supplying it. So then that as per section 18, that a reversal on capital goods will come into the picture. So if it is for up to within a period of 5 years, then you will have to take a comparison of what is the value at which you have sold that damaged machinery for, or the reversal that comes as per the rules by applying that 5% rule. Whichever is higher, you'll have to pay GST on that. Or if it is beyond 5 years, then whatever value that you get in the open market when you sell the machinery, that will be taxable. But that input tax credit, in my view, can be retained, and the reversal will arise only in case where there is where my outward supply is less than the input tax credit points reversal that I'm supposed to do as per section 18.
Great, sir. So we have with us our Rajesh Agarwal ji, Vice Chairman of this committee, who works with us shoulder to shoulder. And friends, I would like to say that PPT will be available to you on the website. The registration, if you have made today for the logistics session, yes, you are not required to do it again, but we will give you the link as well. So this will be validly allowed to you to, and we will share that link as well. If there are, like in question answer, one more comment is there by Sandeep Gupta, 50% of reversal of ITC rule is applicable to NBFC whose license for making further loan is suspended. Sir.
Correct. See, the 50% rule, it only says that you have to be a bank or financial institution to take benefit of that 50%. It does not get into any restriction under any other law. So, insofar as you continue to be an NBFC and you continue to be a financial institution, my view is that that 50% benefit should be available to you. And again, as we discussed that, you should not read in provisions of or violations of other law to determine the tax implications of the GST. Those same arguments can apply even in this case.
Correct, sir. So I request now Vice Chairman of the committee, CA Rajesh Agrawal ji, to give the closing remarks.
Thank you, Bishan bhai. Good evening, friends. Indeed, this was eye-opener session for every one of us. Very different and unique provisions Rushil has covered during his session, because in our routine practice, we don't deal with banking or insurance-related transactions like other industries, manufacturing industry, IT industry, real estate. But thanks a lot, Rushil bhai, for covering in depth all the related provisions, be it valuation, and ITC, all provisions with respect to banking and insurance we have deeply covered. Really thanks to you for your valuable time, key insights, and also dynamic chairman of WARC, who has given his valuable time during this session. Chairman GST committee, Bisan Bhai, for structuring this series and giving your valuable time and key insights during this session. Not only this session will not complete unless I thanks to all the participants and also the all our regional council member who has attended this session. Participants' active participation indeed is shown. The session was very fruitful for all of us, considering the questions asked and the response we have received. Thank you once again to everyone. Thank you, Rushil Bhai. We will have your help in our query solving session also, because a lot of queries we have received from members. So we can invite you for
GST help
GST query
desk as
session
well.
also. Yes,
No,
sir.
happy
Thank
to
you.
help.
Thank you, sir.
Yeah, and if anyone has any further questions, my contact details were shared. You can reach out to me or send it through email or
Yeah.
a WhatsApp message. I'll be happy to address them.
Friends, we have organized one GST RRC at Goa on 25th of July. You can take details from WARC website. It is one of the best structure I have ever attended, and all efforts have been done by Bishan Bhai to for this structuring this event. So I must say that everyone should take the maximum benefit of this RRC.
Yes,
Thank you.
Rajeshbhai, thank you so much for joining. Also, we are thankful to the WRC staff who is there, who is working behind the curtains. So thank you everyone, and let's meet again. Say if you are having queries, then to GST help desk on 14th of this month. Otherwise, we have a planned session on 17th. So we'll be seeing soon. Thank you. Thank you so much. Thanks,
Thank
Rushil
you.
Bhai.
Thank
Thanks,
you.
Rajesh Bhai.
Yeah.